You're tuning in because you want to understand the world better, and sometimes, well, the smartest way to do that is actually by looking at what not to do.
That's right.
Today, we're diving deep into a classic piece of investment wisdom, Benjamin Graham's portfolio policy for the enterprising investor negative approach.
Exactly. And we're looking at guidance from Graham. I mean, a lot of this was written back in 1971, even earlier, but it focuses on avoiding those common mistakes. It's what he calls a negative approach, but honestly, it's incredibly valuable for navigating the markets, even today.
Yeah. So our mission here is really to pull out Graham's key warnings for the enterprising investor, those red flags he saw so clearly. We want to help you, sidestep potential dangers and make investment choices based on solid ground.
Right.
Now, Graham's core advice, it often starts with high-quality bonds, common stocks, the basics. But today, we're going to focus more on where investors might be tempted to, branch out into more aggressive areas and the cautions Graham raises there.
And it's important to get this. Graham wasn't just saying, oh, all other investments are bad. Not at all. He was really providing a framework, a way to think critically if you're venturing beyond those basics, thinking about the risks before you jump in.
Okay, makes sense. Let's get started then. Graham kicks off by briefly mentioning high-grade preferred stocks. He kind of suggests individual investors should mostly leave these to corporate buyers. Doesn't go into huge detail, though.
That's right, yeah. The text itself doesn't really offer a deep explanation for why individuals should avoid them. But, you can sort of infer that the specific features, maybe tax advantages, things like that, they often make high-grade preferreds more useful for, say, a corporation than for an individual investor who's maybe looking for growth or just straightforward income.
Right. Focus your energy where it counts most for you. Okay, now let's move on to inferior bonds and preferred stocks. Grant has some pretty strong opinions here. He basically says, steer clear unless you can snag them at a really significant discount, like at least 30% below their par value for the high coupon ones, and maybe even more for lower coupons. Why such a steep discount?
Well, it boils down to risk versus reward. The higher yields they might offer, they often just don't make up for the increased risk, the risk of default or maybe delayed payments.
Yeah.
Graham puts it pretty bluntly. He says if you buy these at full price, the chances are very great that at some future time the holder will see much lower quotations. It's a direct warning. Big potential losses.
He even gives this really striking example, right, with railroad income bonds back in the mid-1940s.
Yes.
They were trading above face value, around 102.5 on average, and then bam, within a year they dropped to 68.
And this was even though the railroads themselves were actually doing better financially at the time.
Wow.
What's really fascinating there, or maybe sobering, is that the percentage drop in those bonds, which people thought were safer than stocks, was actually bigger than the decline in the stock market around then.
Yeah.
It just hammers home the danger, reaching for extra yield in these lower quality things. The risk to your principal, your initial investment, can be huge.
And this ties into what Graham calls the businessman's investment fallacy. This idea that, it's smart business to take on just a little more risk for a slightly better return. Graham wasn't really convinced, was he?
No, not at all. His argument is basically, look, it's poor business sense to risk losing a big chunk of your capital just for a small bump in your annual income. It doesn't add up.
Right.
If you are going to take on more risk, you should at least have the potential for a really meaningful upside. That's why he says, okay, a second-grade bond trading at par, face value, usually a bad idea. But maybe one that's available at a deep discount, say 70 cents on the dollar, that might be worth considering.
Okay, but he does sort of acknowledge a contradiction here, doesn't he? That these lower-grade issues, they can get hammered in a downturn, but they often bounce back when things improve.
They do. They absolutely have that cyclical nature. But Graham stresses, for the individual investor, it's often just not practical to achieve that average positive outcome he talks about.
How so?
Well, most people can't buy enough different ones to truly diversify away that specific risk. And if you suffer a permanent loss, that's really hard to recover from. Plus, his basic point is kind of hard to argue with. If history shows, you'll probably get chances to buy these things much cheaper when the market's down. Why pay full price now?
Patience is a virtue. Especially here, it seems. Okay, next up, foreign government bonds. These can look tempting, right? Potentially higher yields. But Graham waves a big caution flag, points to their historically pretty poor track record since World War I.
And he doesn't just say it. He backs it up with some really specific, kind of dramatic examples from, I think it was the 1963 NYSE bond list.
Oh, yeah.
Yeah, like Republic of Cuba bonds falling from $117 down to just $20.
Yeah.
Or Belgian Congo bonds at 36 bonds, Greek bonds at $30, even Polish bonds trading as low as $7.
Wow, those are just staggering losses. And wasn't there one with a really wild history? Czechoslovakia.
Oh, the Czechoslovakia 8% bonds. Yeah, their price history from 1922 onwards is just, it's all over the place. Up, down, practically worthless, then back up, then down again. It really shows the instability that can hit international sovereign debt.
Definitely.
Geopolitical events, economic crises.
Yeah.
They can just hammer these things, and fast. Graham also mentions how the reason people invested shifted, from maybe a moral obligation idea to thinking about the U.S. balance of payments. But his core message, still the same, tread very carefully here as an individual investor.
Got it. Okay, let's pivot to new issues in general. Graham advises all investors, basically, approach these cautiously, subject them to careful examination and unusually severe tests. Why the extra suspicion for something brand new?
Well, there are two main things he points out. First, there's always salesmanship involved, right? Someone's trying to sell this new security, so there's going to be hype. You got to be wary of that. Second, these things are usually brought to market when conditions are favorable. Now, favorable for whom? Usually favorable for the company issuing the security and the bankers selling it.
Yeah.
Which might not necessarily mean it's a favorable time for you, the buyer.
Ah, right. The incentives aren't perfectly aligned there. And he says this need for caution gets even bigger as you move from safer stuff like high-quality bonds down the risk ladder to, say, common stocks.
Exactly, yeah. He talks about the experience with lower-grade bonds and preferred stocks in like the mid-40s and early 60s. Aggressive selling probably sucked in less experienced individuals. And these things often looked good based on, recent performance, but they didn't have a long track record. Made them really vulnerable when conditions changed.
Which leads us straight into new common stock offerings, particularly IPO's initial public offerings. Graham draws a really sharp line between companies already public issuing more shares versus a private company going public for the first time. He's much more worried about the IPOs, isn't he?
Oh, absolutely. He often saw IPOs as a chance for the original owners, the insiders, to cash out when the market's feeling optimistic, maybe even frothy. He also noticed how over time, IPOs shifted from being these huge established companies going public to more often being smaller, maybe less proven businesses.
And this often happens during a bull market, right? When, as Graham says it, the large and quick profits shown by common stocks dull the public's critical faculty.
Yeah, exactly. People see others making easy money, and their own judgment gets a bit fuzzy.
Yeah.
The pattern he describes is pretty common, unfortunately. The first few IPOs might be priced okay, maybe they do well initially, but then as the bull market rolls on, you see more and more offerings, the quality of the companies often goes down, and the prices just get pushed higher and higher.
What's a warning sign?
A big one he flags is when you see new stocks of these small, kind of unknown companies being offered at prices higher than established medium-sized businesses that already have a track record. That's a red flag.
Sounds like a classic setup for a fall. And Graham, he really doesn't mince words here. He says this mix of public excitement and aggressive selling, it inevitably leads to a price collapse. Many of these new stocks just get crushed.
Right, and he has that incredibly memorable, very blunt quote, "For every dollar you make in this way, you will be lucky if you end up by losing only two."
Ouch. That's sobering.
It really is. But interestingly, he does offer a potential upside later on. He suggests that some of these same companies might actually become great buys after the hype dies down when they're trading way cheaper and nobody wants them.
Buying when there's blood in the streets, so to speak.
Sort of, yeah. Buying when the initial excitement is long gone. He then points back to the speculative craze around new stocks in the early 60s, followed by big crashes, and knows it happened again in the late 60s, and those horrible examples he gives.
Aetna Maintenance and AAA Enterprises.
Yeah, they really drive the point home. Companies whose stocks soared right after the IPO, then just cratered. One even went bankrupt.
Just stark reminders of the risks of chasing that IPO hype without doing your homework and, keeping a level head.
Exactly. Due diligence and skepticism are key.
Okay, now let's bring this into more modern times. We've got Jason Zweig's commentary on this chapter. And right off the bat, he really doubles down on Graham's point. Even for enterprising investors, playing defense, focusing on what not to do, is still absolutely vital.
Zweig does a great job showing how relevant Graham's warnings are today. He really zeroes in on the allure and the potential dangers of what we now call alternative assets. Things like hedge funds, private equity, venture capital, private credit, private real estate.
Yeah, it feels like you hear about those constantly, these exclusive opportunities. Zweig points out there's a huge incentive structure pushing these, right? The more fees bankers and brokers can make.
The harder they push them, absolutely. Yeah. And the amount of money that's flowed into these alternative funds just in the last decade or so, it's staggering. Billions, trillions even. And the fees that come with that.
That fee hive table he shows is pretty revealing.
It really is eye-opening. It breaks down how the upfront sales charges, the ongoing annual expenses in some of these funds management fees, interest, other costs can really add up. It eats significantly into whatever returns you might hope to get. And Zweig's key point is, look, the returns, uncertain, the high fees, pretty much guaranteed.
And one big selling point you often hear for alternatives is lower risk, right? Because they don't trade on public markets every day. But Zweig kind of shoots that down pretty quickly.
He does. He points to big downturns in things like venture capital in the early 2000s or private real estate during the global financial crisis. Just because something doesn't have a daily price quote doesn't mean it can't lose a lot of value.
So the lack of a public price doesn't mean lack of risk.
Exactly. He explains that private markets, while maybe seeming sophisticated, can actually be less transparent, less liquid than public ones. Valuations can be more subjective, based on guesswork, groupthink, maybe faith, rather than hard market data.
And that survey data he shares is wild. Venture capitalists making gut decisions, private equity guys not prioritizing cheapness.
Yeah, it's quite telling. It suggests the decision-making isn't always as purely analytical as you might assume. And then you have the big blow-ups, Theranos, WeWork, FTX.
Right, huge private valuations, backed by big-name firms charging massive fees. And then collapse.
It just shows that even the supposed experts in these private markets can get it really wrong. And those high fees, they're no guarantee of better results or, frankly, better diligence.
Zweig then tackles this whole investing like Yale idea, referencing Yale's endowment and its long-term success with alternatives under David Swensen.
Right, but he includes Swensen's own crucial warning. The gap between winners and losers in private assets is way wider than in public markets. You need specialized knowledge, a really high risk tolerance, and you absolutely cannot need that money anytime soon, low liquidity needs.
So Zweig breaks down Yale's edge into 5 things.
Yeah, basically. Expertise, time horizon, size, scale matters, resilience, ability to withstand losses, and cash, deep pockets. And he puts it right to you, the listener. Can you honestly say yes to all 5?
Probably not for most individuals.
Exactly. So if the answer is no, then piling into alternatives might not be the smart play, no matter how much hype surrounds them.
And he even points out that many big institutions, like pension funds, haven't actually consistently beaten simpler strategies by loading up on alternatives.
Right. So the evidence for broad outperformance isn't always there, despite the pressure to invest, often driven, again, by those fees. He really hammers home the need for independence, humility, and skepticism.
Another big warning from Zweig, really echoing Graham, is about margin debt. Borrowing to invest, especially dangerous for less experienced folks.
Yeah, he explains it so clearly, how margin magnifies everything. Buy stock with 50% borrowed money. If the stock goes up 10%, you make 20% on your own cash, great. But it goes down 10%, you lose 20% of your own cash. It cuts both ways sharply. And he reminds us, even Graham himself almost got wiped out using margin in the Depression.
Wow, I didn't know that.
Yeah, Graham learned that lesson the hard way and basically concluded most people using margin are just speculating.
And the real danger is the margin call, right?
Exactly. The market drops, your broker demands more cash, and if you don't have it, they force you to sell, maybe selling a perfectly good investment at the worst possible time, locking in a loss. He also flags the hidden leverage within some alternative funds, too.
So even if you're not borrowing yourself, the fund might be.
Right, adding another layer of risk you might not even be aware of.
He also gives a quick nod to how modern brokerage apps on smartphones can kind of encourage impulsive trading, very 21st century problem.
Yeah, the ease, the gamification. It can push you away from thoughtful analysis towards just hitting buttons.
Okay, finally, Zweig really goes after the speculative bubbles we saw recently around SPACs, special purpose acquisition companies, and NFTs, non-fungible tokens.
He mentions all the celebrity endorsements that fan the flames, particularly with NFTs.
Like the Bored Ape Yacht Club stuff.
Exactly. And then, the subsequent crash in trading volume and prices for many of these digital assets, it was a classic boom and bust.
And SPACs, these blank check companies.
Yeah, huge amounts of money poured into them in 2020, 2021. Initial quick gains for some, which, as Zweig quotes Graham again, tends to dull critical thinking.
Makes sense. Easy money makes you less careful.
And Zweig lays out all the potential conflicts of interest baked into this SPAC structure: insider control, the pressure to find any deal, not necessarily a good deal, the incentives for the managers, plus huge fees for the investment banks involved.
And the result.
A lot of them imploded pretty quickly. Huge losses in market value in 2021 and 2022. Another cautionary tale about chasing hype.
So Zweig's final takeaway isn't just avoid NFTs or avoid SPACs.
No, it's much broader. It's avoid the mindset of speculation altogether. Because new manias, new fads, they'll always pop up. They'll look different. But the underlying temptation, the hunt for high returns with low risk and no real work, it's always there.
And it's always futile, he argues.
Pretty much. Higher returns demand taking on more risk, doing more work, being more diligent. There just aren't any shortcuts, no matter how appealing something looks.
So wrapping this up, you, our listener, can really see the power in understanding what not to do. Being an enterprising investor isn't just about finding winners.
No, it's just as much about avoiding the big mistakes, sidestepping those traps that have caught so many others over the years. Prudence is key.
We really hope you'll reflect on these warnings from Graham decades ago and Zweig today. Think about how they apply to your own approach, the opportunities you see, maybe the things you're tempted by.
Ask yourself how these principles fit your situation.
And maybe here's a final thought to chew on. What trends are out there right now that feel a bit like these speculative manias we talked about? What's getting tons of buzz, maybe showing crazy quick gains, but might have hidden risks underneath?
Yeah, asking that question. That's thinking like a truly enterprising investor, just like Graham advocated.
Absolutely. And we'll be back with more deep dives to help you keep thinking critically and navigating the investment world. Thanks for tuning in.